Good morning, everyone watching here live on BAM YouTube. Give me a thumbs up on this video so it can reach more people that are interested in housing in a 24-hour look back on the real estate industry. Let me know in the comments where you're tuning in from, what market you're in, and how hot it is. This hot sheet covers what you need to know about the real estate industry in a 24-hour time period every single Monday through Friday. On today's hot sheet, I will cover a rise in mortgage applications, rumors of new offerings from Wells Fargo, and why a billionaire investor is comparing today's market to 1967. Today is Wednesday, January 18th, 2023, and the hot sheet starts now. We've got incredible news yesterday. Mortgage applications have increased in the latest MBA weekly survey. This is according to Mortgage Bankers Association. I love this news. Hit the thumbs up if you love it as well. Mortgage applications increased 27.9% from 1 week earlier, according to data from MBA weekly mortgage application survey for the week ending in January 13th, 2023. The market composite index, a measure of mortgage loan application volume, increased 27.9% on a seasonally adjusted basis from 1 week earlier. So 28% in just 1 week. This is an incredible number. This is, when mortgage applications are down or sales are down in real estate, and you hear things like, hey, we had a 5% increase, we had a 10% increase. It's like, okay, we had a 5 or 10% increase, but they were down 40%. Right now, we're talking about a 28% pop. Now, seasonally, we get a pop, but this is a huge increase from where we were. On an unadjusted basis, the index increased 32% compared with the previous week. The refinance index increased 34%. Now, that's what I'm talking about too. An increase of 34% on refis it's a little alarming. It's like, okay, why are you refining at 6? But it's also much better than 5 or 10%, which is what we were seeing for refinance as we saw increases earlier. The seasonally adjusted purchase index increased 25% from 1 week earlier. The unadjusted purchase index increased 32% with the previous week and 35% lower than the same week 1 year ago. Of course, that makes complete sense. Reading more into what Mortgage Bankers Association is reporting, mortgage application activity rebounded strongly in the first full week of January, with both refinance and purchase activity increasing by double-digit percentages compared to last week, which included the New Year's holiday observance. Okay, so this is MBA's Senior Vice President and Chief Economist Mike Frattoni. Despite these gains, refinance activity remains more than 80% below last year's pace, and purchase volume remains 35% below last year's levels. Okay, but this 28% increase that we just saw in 1 week, there's not an agent who's active in their local market, who's working the business inside and out right now, that wouldn't tell you that since January 1, they've seen a light switch of some sorts in terms of activity. In the comments, let me know what you're seeing in your local market. Where's your local market? What are you seeing for activity? What does this weekend look like, right? It's Wednesday. We know later today, Thursday and Friday, if you're an agent, if you're a broker, you're going to start seeing people schedule their showings for the weekend. Is your weekend already full? Is the end of this week already jacked up with appointments? Is this mortgage application increasing demand in your industry? Are these new buyers? Okay. Or are these people who have resurfaced from last year? I'm hearing from a lot of agents that we're actually seeing new buyers enter the market, as well as people that were in their database that maybe took Q4 of last year off. So it's both new and people restarting their search, from what I'm hearing from a lot of agents. Love to know from you in the comments what you're seeing. Mortgage rates are now at their lowest level since September 2022 and about a percentage point below the peak mortgage rate last fall. Okay, as we see these rates now hopefully start to stabilize, buyers are going to feel more comfortable with what they can afford in this market. We're already seeing sellers make more concessions. As sellers continue to make concessions, as some of these price decreases start to reflect in closing data in, say, February and in March, some of the under contracts that happened in November and December, those prices will be reflected in the next 30, 60, 90 days. As we start to see that bring down values a little bit and create a new normal for where people are coming in on their offers, buyers are going to have a lot more confidence. You may see over quarter one, quarter two here in 2023, the buyer confidence continue to go up. For the first time in December, we did see consumer confidence go up as it relates to housing. We continue to see interest rates stabilize and prices maybe cooling or coming down. Their confidence will continue to go up. They'll know what they've got to do to get the house that's in their affordability box. Like, they're going to understand affordability a lot more than they did in quarter three when things were very volatile. This would be a good thing to stabilize the purchase market in housing. The refinance share of mortgage activity, we mentioned that, is even up. So people are refining. It boggles my mind that they didn't do this, the last few years when they could have gotten in at 3%. But regardless, people are refining. Maybe they're refining out of a bad loan. I don't know. The FHA share of total applications decreased to 13% from 13.4% the week prior. Interesting there. Obviously, FHA is mortgage-backed loans. So, that's a slight decrease, 0.4% decrease on these government-backed loans. Very interesting. The VA share of total applications decreased 11.8% from 13.2% the week before. USDA share total applications remained unchanged, 0.6% from the week prior. The average contract interest rate for 30-year fixed mortgages with conforming loan balances $726,200 or less. That's obviously the new conforming limit for government-backed loans, decreased to 6.23% from 6.42%, with points decreasing to 0.67 from 0.73. Listen, a lot of people are going to be, still hearing these 6.25%. We know that last week that Mortgage News Daily reported that it was in the low sixes. In your local market with your lender, you're probably able to get some. If you're a lender, let me know, right? You're probably able to get some qualifiers in below 6%. On yesterday's Real Word podcast, Nicole and I talked about how, hey, 5.99 sounds a lot better than 6.01, right? So if you're able to get some folks locked in the high fives, that's going to be very attractive to them. Just seeing a 5 as the first number is going to be very attractive. It's going to give people more confidence in their shopping. So everything's a local level. This is a national number that we're talking about as it relates to these 30-year fixed rates. I would definitely, if you've got an opportunity to get people locked in the fives, I'd be screaming that from the rooftops. Update on some of the charts that we saw yesterday. This is from @NewsLambert on Twitter. We shared the mortgage purchase application chart yesterday. He's already updated it from yesterday with this MBA news. Let's check out the latest. Okay, so this is a mortgage purchase application index, seasonally adjusted. We now see this straight line up right here. Okay, I'm going to zoom in here just for a second, and I have a zoomed in chart. This line is now going straight up. This is updated from yesterday. If you want an unmarked version of this chart, just go to the link below. All of our sources and all of our charts are going to be available in the link below every single day. We made that happen per your request. Hit the thumbs up if you love that. I know a whole bunch of you guys did download charts from yesterday. This is an updated chart from yesterday, so make sure you go and grab this one. Here's the zoomed in version of that chart. Mortgage purchase application index. You can see here, this number is going straight up on buyers going out and applying for a mortgage. So if I'm at a listing appointment as a real estate agent, I'm absolutely bringing this chart with me. We don't want to wait till March when all the other homes are on the market. Right now, buyers are applying for a mortgage. Buyers are coming into the market right here, right now. It's happening. Let's get out in front of all the inventory that naturally comes on the market in the spring. I want to show that chart to sellers who are sitting on this, who are thinking that March and April are going to be their best opportunity. Listen, prices are on a trend of cooling in most markets. If you wait till March or April, you're basically selling against those comps as opposed to the comps right now that are near peak. Okay, I want the comps that are near peak, and I want the less inventory, which is what we're seeing right now. And I want these buyers that are rushing into the market. I want to be able to go out and get those buyers bidding on my home while there's less competition before these prices continue to cool. That's what's happening. This chart is an absolute banger. You should download it in the link below if you're interested in using that, especially if you're somebody who wants to go out and get more listings in your business, be it an agent, a broker, a team leader, or what have you. All right. We've got an update on this Wells Fargo news from last week here. Wells Fargo getting out of the mortgage business. They announced that last week. They're going to stick in with, obviously, their wealth management clients. They're going to stick into some minority communities that they want to serve, and maybe some of their customers, Wells Fargo, but they're not going to be in the business of buying loans, okay, from, another bank, right? They're not going to be in the business of loan origination if you bank somewhere else. Okay, so they announced that last week. It was interesting news. Housing Wire, though, is reporting today that they're not done cutting their mortgage business back. Housing Wire says rumors of a mega MSR offerings from Wells Fargo is stirring the market. The reputed Wells Fargo mega MSR sales, if accurate, could squeeze market liquidity, drive down prices, MSR experts say. Okay, so the mortgage servicing rights, MSR. MSR is when somebody goes and gets a loan, Loan Depot or whoever, right? And then somebody comes along and buys that loan, right? Listen, if you're working with buyers right now too, don't let them get a month after closing until they realize my loan is sold. If you're working with a lender who oftentimes that loan is going to be sold, let them know ahead of time, hey, in a month, your loan's going to be serviced, MSR, mortgage servicing rights, by somebody else. 9 times out of 10, this is what happens. Here are the advantages to working with this lender. Your loan's going to be sold. Nothing's going to happen. Let them know about that process well ahead, especially if you're an LO. You should be definitely educating people, hey, this is what's going to happen. Your loan's going to get sold. Good, bad, right? Somebody feels different about that. Maybe they go to a local lender and where they service it in-house, and there might be a cost disadvantage to that, maybe an advantage. Who knows? You want to overeducate people so that they don't get into the point where they feel duped. They know about this up front. Okay, just a little sidebar there. Mortgage servicing rights, MSR market has opened 2023 with a healthy volume of capital committed to purchasing the assets, along with multiple sellers primed for deals, as evidenced by the $60 billion to $65 billion in MSR portfolio offerings currently out for bid. All right, so there's 60 to 65 billion of these banks putting those loans, 60 to 65 billion in volume of these mortgage loans out on the market. Okay, so it doesn't say who the banks are, but they're saying, okay, I've got Fannie Mae loans, I got Freddie Mac loans. I'm going to bundle them together. If you watch The Big Short, right, I'm going to bundle them together. These happen to be much better loans than what was being bundled together back then, but I'm going to bundle these loans together and go sell them. 60 to 65 billion is on the market right now. Wells Fargo, though, is about to drop 250 billion of MSRs onto the market. Okay, so what's that going to do for supply if Wells Fargo does this? If they drop 250 billion of MSRs into that market, where there's only 60 to 65 million being offered, it's going to bring prices down on these loans. Okay, very, very interesting that Wells Fargo wants to get out of holding $250 billion worth of these mortgage loans. These are Fannie and Freddie Mac backed MSRs, which are the best of the best. Okay, and they're getting out. 150 million of this is going to be Fannie and Freddie, while 100 billion of this, excuse me, I think I said million, 100 to 150 billion is going to be Fannie and Freddie. Then 100 billion would be Ginnie. Okay, so I don't know. It's interesting to me that Wells Fargo is doing this. Do they believe that foreclosures are going to be on the rise. They've been at all-time lows. There's only one place for them to go. Okay. Are they just truly, not able to provide a great experience for consumers and a great margin for consumers on their mortgage business? That seems hard to believe. I mentioned this last week on the hot sheet. There's some subtle yellow flags for me, with Wells Fargo getting out of the business. Housing Wire also reports that PennyMac might be in position to scoop up some of these deals. They reported that today. So interesting left. PennyMac is looking to capitalize on Wells Fargo exit. Obviously, there's going to be a lot of banks, if they put that $250 million or billion, out there, that potentially look to acquire that. Okay, some contradictory news. This is starting to become a slight trend where we're seeing more investors, more economists have an optimistic look at quarter one, quarter two, quarter three, quarter four of 2023. An optimistic look at our markets. You're starting to see people talk about a soft landing. You're saying, hey, wait, China's open and we may not have a global recession. That might mean we don't actually have a deep recession here in the US. And just yesterday, we had a billionaire investor say 2023 is going to be like the 1967's rolling bull market. Okay, this is according to Ken Fisher, billionaire investor on Fox Business, said inflation is deader than a doornail. It just doesn't know it yet. Fisher Investments founder, chairman Ken Fisher, argued Wall Street is on the verge of a roaring bull market akin to 1967 Summer of Love. That sounds fun, which saw a stunning stock rally. Okay, obviously, if you've been in the stock market the last 2 years, really, you've continued to watch your portfolio go down and down. A lot of people in 2022 just were like, I'm done opening the app. I'm not even going to look at it. My stocks just continue to go down. He's saying we're going to see an incredible bull market here in 2023. Ken Fisher, first, to see it, the bull market, you have to see that 2022, almost anything you say about it could be said almost perfectly the same way about 1966, or just slightly differently. Rate hikes, explosive inflation out of nowhere, big regional war. Obviously, we've got the Russia-Ukraine situation, the most divisive era in U.S. politics. Okay, there's a comparison there. You could go to recession expectations and anticipation of capitulation and a bear market. That was the same magnitude. Talking about 1966, started almost the same day in January and almost the same day in October. The fourth quarter rally was almost exactly the same size. A strong start to 1967, like we're having now. Obviously, stocks were down a little bit yesterday. They're up a little bit as it looks today on the opening bell. But yeah, we did have a slightly strong finish in quarter four. And maybe some people would argue how strong that was. And in reality, from all of that, 1967 is the year when inflation peaks and falls, interest rates plateau, and we don't get the recession because widely anticipated recessions are met by mitigation and anticipation. It's the most parallel period in modern history. That's the most interesting takeaway from Ken Fisher, this billionaire investor, is that he's absolutely right. This recession is really, talked about for a long period of time. We did technically have 2 quarters of negative GDP, albeit very small, in a great job market in 2022. So some people thought we were already in a recession, and we keep talking about it week over week over week. When is it coming? Is it going to be deep? And oftentimes when that happens, to his point, you're so well prepared. People have made job cuts, like you've seen in the tech and the housing industry, so far in advance that they're so well prepared, and we actually have a much smaller recession or no recession at all. He goes on to say, I believe inflation is dead. It's deader than a doornail. It just doesn't know it yet. The fact is, inflation is a process. Input costs lead to producer prices, which lead to consumer prices. If you look at input costs like commodities, or you look at processing costs like freight costs, all of these on average are down to where they were more than a year ago or lower. This is becoming a trend. This could be good for everybody if this trend continues, where we're saying, hey, soft landing, recession's not going to be as dramatic as we may think. We'll see who's going to be right. There's still people calling for a very deep recession and even a global recession. So there's both sides of the coin here, and we'll continue obviously to take a look at that as we move forward every single week. Let's take a look at the 10-year. Yesterday we talked about it being up a tick in front of the show. That correlated in a small 30-year fixed mortgage increase yesterday. Yes, the 30-year fix went up. Okay, where's the 10-year at today? And hopefully how's the 30-year going to respond to that? Today, the 10-year is up. Is down a pretty good amount. Okay, so we were at over 3.5 yesterday. We're now at 3.392 on the 10-year. You see the one-day range 3.430 to 3.558, but down 0.158 basis points. That's really, really good on the 10-year. Good positive news, which should reflect positively in the 30-year fixed mortgage rate. Yesterday, we saw that number up here on the hot sheet, and then we did see the 30-year fixed mortgage go up. Okay, so January 17th, Tuesday, yesterday out of the holiday, we were at 6.17. According to Mortgage News Daily's 30-year fixed daily survey. We ended the week last week at 6.09. I expect this number today, if this 10-year sticks throughout the day, to come down. Tomorrow we should be talking about maybe even something lower than 6.09, which is where we ended the week yesterday. Could even be very low sixes or potentially high fives, depending on where they come out later today. And there you go. That is your 30-year fixed update. As we continue to track that, mortgage applications, of course, are up. If this number continues to go down, they may continue to go up in a substantial way. Yes, right now, mid-January to May is seasonally when these applications go up. This is good news, obviously, for home shoppers and home buyers looking to lock into a low rate. Please consider sharing this show with somebody who loves housing, who wants to learn more about the real estate industry and wants to have that 24-hour window look back on everything they need to know to get prepared for the day. At 11 a.m. here on BAM YouTube, we've got the Massive Agent podcast coming up. Make sure you're subscribed to this channel so you don't miss anything. And I'll see you back here tomorrow at 9:30 a.m. Eastern.